Welcome to OnAir with Akin. I'm Jason Daniel, a investment funds regulatory partner in the Dallas office.
And I'm Barbara Niederkofler, an investment fund partner in the New York office.
We're going to go through a series of 3 podcasts that will talk about the recent regulatory changes, the proposals that are still out there, and how all this will impact your fund documents and your practices and procedures. For the first one, we're going to talk about, going into a little more detail, what was adopted in the beginning of the year, the last month, and also a bit in January, and what was proposed in the last months, and also enforcement action and staff guidance. So the first stop is to go through the rules that were adopted in the last month or so. First up, I guess, would be, Barbara, the dealer rule.
Yeah, so let's dive in. On February 6th, the SEC adopted 2 new rules interpreting the definition of a dealer. The Securities Exchange Act of 1934 defines dealer as a person that is engaged in the business of buying and selling securities for such person's own account through a broker or otherwise. The term dealer does not, however, include a person that buys or sells securities for such person's own account, either individually or in a fiduciary capacity, but not as a part of a regular business. This not as a part of a regular business phrase provides the traditional dealer or trader distinction that permits investors to acquire or sell securities without registration. The SEC's new rules redefine as part of a regular business phrase to include persons operating in the market beyond the traditional dealer functions of acting as an underwriter or a market maker, to also include a person that engages in a regular pattern of buying and selling securities that has the effect of providing liquidity to other market participants by either, 1, regularly expressing trading interest that is at or near the best available prices on both sides of the market for the same security, and that is communicated and represented in a way that makes it accessible to other market participants, or 2, earning revenue primarily from capturing bid-ask spreads by buying at the bid and selling at the offer, or from capturing any incentives offered by trading venues to liquidity supplying trading interest. The new rules include some safe harbors. One safe harbor is for a person that has or controls total assets of less than $50 million, is a registered investment company, a bank, or a sovereign entity, which means a sovereign country or an agency or subdivision thereof, but is not intended to capture sovereign wealth funds, or an international financial institution. Private funds, however, are specifically not included in the safe harbors. So an advisor or a private fund could be required to become registered as a dealer depending on its activities. The dealer rules adopting release notes that hedge funds are more likely to meet the final rules definition of dealing, although private equity funds and liquidity funds are less likely. In light of the uncertainty regarding the application of the dealer rules, investment advisors will need to carefully review their trading and other activities to determine whether they or the funds they manage engage in activity covered by the qualitative standards of the phrase as part of a regular business, or whether they or the funds they manage could otherwise be perceived by the SEC as a dealer. The compliance date is 1 year after the effective date of the rules.
So for funds that I guess are trading a huge amount of volume, or even a smaller market, I guess, like fixed income is one that, if you're trading back and forth, that's something that depending on how you're trading and how you're communicating, and whether it's a fundamental value determination, that those all may enter into determining if you have to consider registering as a dealer. But I guess it's not like all hedge funds have to register. Didn't they say that it was like 16, wasn't it?
Yes, that's right.
That SEC had identified, which isn't that many, really.
But there is still quite a bit of uncertainty on how these rules will get applied.
especially when you're talking about the liquidity provision, which incidentally many hedge funds do just by trading, just by operating. That's not really necessary. That's not necessarily all that's required. So the next item that was adopted in February was the amendments to Form PF. There's actually been a number of amendments to Form PF. Just in 2023, there were changes to the questions for private equity funds and the new Section 5 and Section 6, which requires an amendment within 72 hours after certain events or within 60 days after the end of the quarter for certain private equity events. This is a new change that is mainly targeted at hedge funds. It also restructures Form PF dramatically in an unfortunate number of ways. First, it requires feeder funds in a master feeder structure to be disaggregated, so that if that feeder fund holds anything other than cash, certain cash equivalents, which has been narrowed, and T-bills, not just government securities, but T-bills, then you can continue to treat that as a disregarded feeder and just report it on an aggregated basis with the master. But if it holds any government securities other than T-bills or anything else, then those feeder funds will be required to be disaggregated for reporting for that portion that's not invested in the master. So that may dramatically increase the amount of reporting that registered investment advisors have to file in their Form PF. Also, the fund of funds analysis has been changed. Previously, they were able to be disregarded for many purposes, including after you got to the 150, at least determining if you were a large hedge fund advisor. Now you do have to count it for purposes of determining what level you have to file. Also, there's a new concept called trading entities. For a trading entity, if you hold assets, and it can be even just one security, hold any assets, if you engage in trading or you incur leverage at an SPV level, then you're required to report for that trading entity. But that doesn't mean that you have to report the trading entity as a separate fund. You just list on part of Form PF that you have a trading entity and what you use it for, whether it's trading, asset holding, or leverage. And then you look through on a pro rata basis through that trading entity for reporting for the fund that owns that trading entity. There also is a lot of moving around of information. The Form PF Section 2A is actually removed. And now the reporting is just for 2B, the qualifying hedge funds, the hedge funds with more than 500 billion in net assets value. The information for those reports is also dramatically expanded, as you would have expected. A lot more granular information is required. There's also some changes to how positions are determined. So things that if they were tied positions, like some sort of a straddle position, could be looked at as one position if they're with the same counterparty and were entered into for the same purpose. Now those will be required to be disaggregated. Also, information regarding interest rate swaps will be reported on a 10-year bond equivalent basis. The compliance date for that is 1 year after the publication in the Federal Register, which I have not seen yet.
So we still have some time.
Yes. Yeah. So one other thing is that there's changes to investor types, which we'll come back to later, that may impact. So proposed rules, the big headline one is AML, the third time around for try AML. Barbara?
Yeah. So on February 13th, and in an effort to address increasing illicit finance risks in the investment advisory industry, the U.S. Department of the Treasury's Financial Crime enforcement network, FinCEN, in its notice of proposed rulemaking, proposed to include registered advisors and exempt reporting advisors in the definition of financial institution under the Bank Secrecy Act, and require these registered and exempt reporting advisors to establish risk-based anti-money laundering and countering the financing of terrorism programs, including developing internal policies, designating an AML CFC compliance officer, and other items. The proposed rules would also require advisors to file suspicious activity reports and currency transaction reports with FinCEN, and they would also need to maintain records relating to the transmittal of funds to comply with the record keeping and travel rule under the Bank Secrecy Act. There is a 60-day public comment period, which ends on April 15th.
And so that is the third time of trying. It does seem like it's more likely to pass now just because of the international context. It seems more likely to be adopted.
Yeah.
I guess also the SEC a lot of times comes in to enforce on this to look over the shoulder of broker dealers. And so that's another thing to worry about on exam. In the least important regulatory development is actually the adoption or proposal to change the asset threshold for venture capital funds. So back in 2018, there was a change that was kind of subtle because for most of our clients don't use it. For venture capital funds, if they had less than 10 million in total assets, in total commitments, you could actually have up to 250 in beneficial owners instead of the normal 100. The SEC is permitted to change that number, for the total commitments number for inflation adjustment. And so there's a proposal to change that number to 12 million. So now on to something more important, the enforcement actions in the last month.
So recently, the SEC brought a whistleblower action over retail client agreements. The action related to a practice of requesting retail customers to sign confidentiality agreements if the customer received any credits or settlements. And the SEC took issue with the fact that the confidentiality agreement did not permit the customer to voluntarily report violations to the SEC. The SEC's order marks an escalation of the scope of agreements the SEC is scrutinizing for whistleblower-related actions. And this may be an area to watch for the private funds industry. Moving on to the section of approaching or recent compliant dates for adopted rules. Jason, I know there's been a lot of activity on Schedule 13D and 13G, so I'll hand it over to you.
Yeah, so the most material is Schedule 13D. The timelines now, the due dates have effectively been changed in February, on February 5th. So now the Schedule 13D is due 5 business days after an acquisition that results in you beneficially owning more than 5%. The amendment timeline has also changed. It used to be promptly was the requirement. Now it is the second business day following the date of the transaction, which is like the Form 4 timeline. Keep in mind that if something is really material and you're going to be acting on it, the SEC can still go after you on a kind of a manipulation theory. So if you have a change in intent and you're acting on that, I wouldn't use the second business day concept as a get out of jail free card. I wouldn't rely on that. For 13Gs, the timeline for that is actually starting in September 30th. The required filing dates will change. Things that are now annual. So if you're an exempt filer because you own pre-IPO and you haven't bought more than 2%, if you're a qualified institutional advisor making the first filings, and the amendment timelines, which were normally 45 days after the end of the year, are now 45 days after the end of the quarter. For passive holders that are not a regulated institution, they have to file 5 business days after the end of after the transaction that makes them more than 5% owner, just like a 13D filer would, and then they would go to that quarterly amendment timeline. There are more rapid filing timelines for if you cross 10% other than as an exempt filer, but I won't go into those. The same cooling off period though still applies, which is if your intent changes, you cannot vote or acquire securities for 10 days until 10 days after you file the 13D. Note that is something that the SEC is beginning to bring enforcement actions on, so you should pay attention to that. So then next is the what's still out there is, of course, the elephant in the room of the private fund advisor rules.
Yes, Jason. So the compliance date for certain rules applicable to private funds will begin to apply in September, assuming that they are not overturned or vacated by the Fifth Circuit. So for all investment advisors, so whether registered or even exempt reporting advisors, the preferential treatment rule and the restricted activities rule, as well as then for the registered investment advisors, the advisors-led secondaries rule, the compliance dates are as follows. So for advisors with $1.5 billion or more in private funds assets under management, the compliance date will be September 14th of this year. For advisors with less than $1.5 billion in private funds assets under management, it will be March 14th of next year. And for registered investment advisors, there's also the quarterly statement rule and audit rule, the compliance date of which is March 14th of next year.
But this is very much so complicated by the fact that it's subject to challenge at the Fifth Circuit. So the question is, when do you start? And if it's overturned, what's left? What do you still look at as lessons after it's overturned? Both of those are things we'll punt on because, well, we don't know exactly how that's going to go. We have theories on what the timing is, but we're not going to repeat those here. But once we get to a go or no go, there'll be a certain point where we just can't wait for the ruling. You have to start to adopt things if it's long enough. And then again, after, if it is overturned, then we have to consider what will still show up as SEC policies.
That's right. And also there's the question of whether the entire private funds rule would get overturned or just certain parts of the rule. So stay tuned. Another set of approaching dates for adopted rules fall under the Corporate Transparency Act, as well as the New York LLC Transparency Act. And so just stepping back, the Corporate Transparency Act and the related rules and regulations will require reporting of existing non-exempt entities and their beneficial ownership as of the end of this year. And subsidiaries of private funds managed by private fund managers that are exempt from registration with the SEC, other than venture capital fund advisors, and parent companies of investment advisors may well have to be reported. And we've issued client alerts on the timing and the various exemptions. And while we've been focused on the Corporate Transparency Act at a federal level, there's also the New York LLC Transparency Act, which requires all existing and newly formed limited liability companies formed or qualified to do business in New York to file in New York and confidentially disclose beneficial owners. Note, this will impact LLCs regardless of jurisdiction of formation. So, for example, a Cayman LLC that are qualified to do business in New York. The non-exempt LLCs formed or qualified in New York before December 21st of this year will be required to file with New York by January 1st of 2025. And entities formed after that date will be required to file their beneficial ownership information at the time of filing their articles of association or application to do business in New York. Any changes to beneficial ownerships will be due within 90 days. The New York LLCTA incorporates the exemptions from the CTA, but requires a filing with the state of New York stating on which exemption the LLC is relying. And entities relying on an exemption and that were formed or qualified to do business in New York before December 21st are required to file with New York by January 1 of 2025.
So now on to a number of trading and voting and investing forms. So we have a form NPX, the short sale reporting, and then the settlement cycle is also short. Form NPX, it will require any institutional investment manager that's filing Form 13F to report any say-on-pay votes. What are say-on-pay votes? It's a vote approving the compensation package for the executive officers of a Section 12 reporting company. So we're talking about companies on exchanges, companies that are traded on the over-the-counter basis and have a registered class of equity securities under Section 12G. So it's approving the compensation package, approving the frequency with which those votes are held, 1 to 3 years, and approving golden parachute packages where you are approving payments that occur on a change of control. These forms are due by August 31st, relating to all votes that occur or any exercise of voting authority that occurs before securities you own through June 30th. Exercise of voting authority is very broad. It counterintuitively includes the determination not to vote. And you also have to report shares loaned. If the determination not to vote, if you have a policy of not voting for any securities, and you've told your clients that you're not going to be voting securities pursuant to policy, you don't have to report, but otherwise the determination not to vote is an exercise of voting authority. Also, if the prime broker is lending out securities, that's not you, so that's not counted against you. Because of the way it's formatted, where it requires the form NPX has to have the statement that exactly parallels the language in the proxy card. We recommend that our institutional investment advisor clients use a proxy advisory firm. I know that proxy advisory firms have a report that they can provide that already has that information filled in. That's the much easier way to have it done because you're already voting through them a lot of times and you can just get the report from them. Short position reporting. This isn't until January 2025. And so, there's an opportunity to challenge this before it's implemented. It requires an institutional investment manager, but not just an institutional investment manager that files a 13F. It's anyone who has a gross short position or an average gross short position, depending on which one we're talking about, over the threshold. For the month, you have to go back and then report your gross short position, plus you have to report the change in the gross short position over the month. And that's part of the controversial part. The threshold makes some sense for the U.S. reporting securities. It's 10 million or more, or 2.5% of the outstanding for equity securities for a U.S. reporting company. But for all other equity securities, if there's a gross short position of 500,000, you have to report. That 500,000 seems pretty low, especially because it picks up a lot of if you have a non-U.S. short position, that would pick it up. The filing will be due within 14 days after the end of the month, and will require then the SEC to take those positions, aggregate it, and report it publicly. Finally is the change to the settlement cycle. Starting on May 5th, 2024, the settlement cycle will shrink to 1 business day following the trade date. And so in order to ensure that actually can that kind of straight through processing that would be required for the 1 business day T+1 settlement, you have to affirm your trades with the broker on the trade date. So what does that mean? You put in an order, the order is confirmed. We filled 10 million shares. Then you have to provide an affirmation of this is how I want the shares to be broken down and allocated among the accounts by the end of that trade date. So then on the settlement date following, it can actually settle into the correct accounts. You have to, an investment advisor, what has to do with investment advisors, they have to keep books and records of that affirmation process and communication with the broker dealers in the books and records, and that may be subject to examination. Now on to staff guidance. There's a new marketing FAQ.
Yeah, so February was a very busy month for the SEC staff, but the staff did issue a new FAQ on the marketing rule. It's only the 4th FAQ so far. The FAQ asserts that when an advisor advertises its private fund's performance in terms of gross internal rate of return and net IRR, representing gross IRR that is calculated without the impact of fund level subscription facilities compared only to the net IRR that is calculated with the impact of fund level subscription facilities, would violate the marketing rule. In addition, the new FAQ also states that it would violate the general prohibitions under the rule if a registered advisor uses net IRR that includes the impact of fund level subscription facilities without including either 1, comparable performance, for example, the net IRR without the impact of fund level subscription facilities, or 2, appropriate disclosures describing the impact of such subscription facilities on the net performance shown. And so this concludes the first part of our podcast. As we've discussed, there's been a lot of activity by the SEC in the past month or so. And please join us on our second part of the series discussing the still pending proposed rules in the funds industry space. Thank you for listening in.
On Air with Akin is presented by Akin and cannot be copied or rebroadcast without consent. The information provided is intended for a general audience and is not legal advice or a substitute for the advice of competent counsel. Prior results do not guarantee a similar outcome. The content reflects the personal views and opinions of the participants. No attorney-client relationship is being created by this podcast, and all rights are reserved.